Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table. Welcome. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. My name's Seth Krussman, and joined here once again with Dan Mickelin and Benjamin Brayshaw. Hey, how are you guys doing?
I'm doing great. I'm doing very well.
Optimism abound, you know?
It's a way to be.
That's right.
It's been a week since we've been here doing this, and lots happens in a week. We're going to be talking about personal finance, three-dimensional investing, and today's topic or show really is coming back into this place of no pension, no problem. We've done several in the series of this show that if you're trying to create income in retirement, these are the shows that you really want to dive into and kind of work through the concepts or the different solutions that we're talking about. Today we're going to be talking about creating income in retirement through dividends. What we've talked about so far is we've talked about real estate, we've talked about annuities, we've talked about bonds, and today we're going to spend the majority of our time in the dividend space, but also we're going to do a little bit of a kind of a wrap up, I think, for where we've gone in this journey of we realizing that we do not have pensions in place like we used to. What do we do?
Yeah, this is a little bit of a wrap-up show. This is a big piece of what we do is the dividend space. So I don't want to shortchange that conversation, but we're going to talk about a lot of detailed information today. But you're right. I think all the different topics we've talked about, I think what's really unique, and I think what I hope that all the listeners go away with, and Seth, you did a good job outlining the kind of the four pillars, I would say, that kind of line up for what income is mostly attributable to for those who are retired outside of the pension world. But the idea that not every one of those sectors is going to be in favor, right? Like they're not all going to be the one that is right for now or is right for the entire period. And I think that's kind of the point to the entire show that we're talking about, because we were talking about last week. The bond space has really lost favor with where the market's at, and that's a hard thing. And then, but annuities have gained favor significantly over time.
Yeah, I mean, I think that goes back to be diversified. That's kind of one of the foundational planning elements that we always talk about, and people hear that in mainstream media, and it's kind of an old adage at this point, but it's true. You never know, which sector, which industry, which tool, which option is going to be the best for you, and seldom is any option the best for 30 years of retirement, right? There's going to be different times where different things work out better. And you don't necessarily, doesn't mean that diversified doesn't mean that you're not maybe leaning or slanting in one direction more, because there's opportunity there, right? You're not foregoing opportunity, but you're not completely dismantling, not having, a bond portfolio right now just because rates. I mean, so there's a real balance between, targeting your opportunistic retirement story and where the market's at, and then also being diversified. Yeah, you don't necessarily fill each bucket equally, but you better have all the buckets.
Yeah, it's funny because the J.P. Morgan article we referenced in the very beginning almost has every bucket equal. But then again, they're in everything. So
we got a lot to cover and to be able to get into the a little bit of a review here. So, hey, we're going to get into money in the news.
First up, we have surging food prices. This article is from Fox Business. It's by Jaewon Kang. I mean, and I think we all know inflation is first and foremost. And I think we have people that contact us about, how do we mitigate our costs, our expenses, our budgets? It doesn't matter what wealth level you're in. I was just talking to a gentleman today, just saying I was looking at going on a trip skiing with family and friends. And he goes, I can afford to pay for this, but I just don't feel right spending that kind of money. Now he's wealthy. I mean, it's not about that he couldn't stroke the check, no big deal. It is just so expensive. He doesn't feel like he is acting in whatever his honorable or integrity story is around money. And I think that's how we all feel. We all have those limitations of where we spend, but it's hitting our pocketbook at a completely different level. This article goes into everything from a health counselor trying to figure out how to eat healthy and maintain the financial budget. Her and her son were able to live off of about $125 to $150 months ago, and now it's over $200. And she's analyzing, and as many people are, where am I going to shop today for my food?
Yeah, I mean that's the difference between a ski trip and the example versus food on the table. I mean, some of it's discretionary, some of it isn't. Right? You got to eat, and so these cost increases are real, and they've impacted us, into the real core necessities of life. And specifically, they're talking about the consumer price index for goods and services is up 7% in December for the same month over 2020, which is the fastest pace since 1982. And I think we've talked a lot about different inflation metrics on the show in the last few weeks, and they all go back to this 82 period. So it's incredible that 40 years have gone by since we've really experienced anything like this. But I mean, I know it. A gallon of milk, $7 these days. When I got 3 young ones at home, we go through a lot of it. I keep talking about that too, but it just blows my mind every time.
Well, that's not the only thing increasing on us, right? We've got home prices. Home prices rose in November 18.8%. Anna Bainey reports on the CNN.com article. Now, this is really a very interesting thing. I think we're all hearing about how real estate is just flying off the shelf, but that's actually a slowdown. It's shocking to say that 18.8% is a slowdown compared to the 19.1% increase that was in October.
It's absolutely incredible. I mean, as you read through the article, it says out of the 20 cities that they're tracking, prices were up for 19 of them at their all-time highs. So, I mean, that's just it's crazy. I mean, you might think it's local or it's in some certain restricted, high-profile areas, but the fact of the matter is, real estate coast to coast, every nook and cranny of this country is exploding. It's getting to the point of, it feels like it's an opportunity to sell, but then where do you go?
Well, you got 20 million illegals coming through the gates. What if they got to have a place to live? So,
isn't FEMA taking care of that?
Whatever. Oh man. Well, seriously, but in all seriousness, the home prices are out of control. It's really shocking to me, and I still wonder. Seth, you're over on the West Coast, but here, the conversation of people moving out of Massachusetts into New Hampshire to get away from a lot of the Massachusetts kind of lockdown and measures that they've done, or just to even get more space, more land, just kind of get out of the city because of Corona and get away from people. All of that made sense to me. And I actually know a gentleman, I was talking to him today, he bought a condo in downtown Boston in the middle of the coronavirus. He's like, well, I love going there. Never owned a condo. Things were 50% on sale. Bought one. I'm sure he's made a ton of money off of that.
Oh, yeah.
But I'm thinking to myself, why are all the cities growing? I understood the kind of move out of the metropolis, get away from everybody in the coronavirus and the pandemic, but I don't necessarily understand how everything's growing everywhere. That's crazy.
Yeah, people love the city life. They just want to get back in there.
Some of the places that did make sense were, warmer destinations like Phoenix or Miami, and people kind of just pulling some of the ideas off the shelf that they've had cooking there in the background and realizing, well, why don't we go ahead and make these moves? But the inventory situation being what it is there's just that shortage out there driving prices higher, as well as new homes coming online. It still looks like, big picture, that there's just a supply and demand story where even though it's cooled off, or there has been less transactions with rising rates and those kind of things in the background, it looks like a pretty strong supply and demand story still.
I think when we look at these two articles, I know we have one more to go over, but as we look at these two articles and we talk about the surging home prices, the surging food prices, I think about each and every investment opportunity that we kind of meddle through, like the idea that frozen foods are cheaper than fresh produce, right? And you're seeing a surge in sales on frozen foods. So then you start looking at different frozen food manufacturers and different distributors and the companies around that. I think from an investment standpoint, there's that. I think also looking at the market cycling through and all the craziness that abounds, the ups and downs, down 1,000 points, up, back, recover 1,000 points. I mean, these last few days have been crazy. So looking at all of that and then looking at home prices still going up 18.8%, like looking at the demand, I don't know anybody who hasn't bought a house who doesn't do some major project to kind of make it their own. So, Lowe's and Home Depot and all these stocks that are getting like hammered right now. I think there's real opportunity out there in these, not necessarily those particularly, but I mean, whether it's, bathroom companies or fixture companies, I mean, there may be a supply issue, but there's no demand problems. So if you're going to do your bathroom, you've already decided you're going to do your bathroom. When you find the contractor to do it, he's going to do it, and he's going to get the tub, he's going to get the shower, he's going to buy all that stuff. It will eventually happen. So I think that ongoing demand's not going anywhere.
As long as you don't need any chips. Then you got to wait 2 years. So.
Yeah. You need chips? We can cut wood.
So. Speaking of chips, not really. There are 8 strategies that you can use or are recommended. This is a CNBC article on lowering your fuel cost. Because if you've been to the pump lately, which more than 90% of us, I think, have, we've noticed some of those gas prices that have been going up and up and up. And they're not getting any easier, right? So what can we do to mitigate some of these places? And thank you again. This is an article by Mike Winters for giving us some ideas what we can do to lower our prices at the pump.
Yeah, I thought this one was interesting. I think people are looking for ways to kind of bring down that cost. But in reading through it, I didn't realize there was all these different kind of techniques to potentially doing it, and they don't all involve buying an EV, although. Looking for a car with some fuel economy is one of the points. But the first thing they talk about is, taking it easy on the gas and the brake, right? Don't drive too fast. Don't slow down too quickly. There's the wear and tear on the engine. And, being a Massachusetts native and a longtime Boston driver, I can say I could probably improve in both of those areas.
Well, that's a survival skill, right?
Dan, that is so understated. Dan doesn't even know what the disparity of those two items actually means.
As fast as I can till I can stop as quick as I can, right? That's...
Within inches. Within inches.
I've never hit anything yet.
I thought this was interesting. Avoid excessive idling. I don't know anybody that doesn't know that one, but that's helpful.
And one thing is the new car I got, it has that built into it, and that drives me absolutely crazy. It just turns off the engine if I hit a red light. It just shuts the thing down, and it never comes back quick enough.
It's a weird feeling for sure when you're sitting there and you're realizing, okay, the car is actually not running, and I'm about to need to go. Like, I'm not sure when, but it's going to happen.
I turned that feature off.
I do all the time. I just got to figure out how to set it. But.
I think they estimated that was only going to save you 1 to 2 cents per minute of idling. So I'm good. Like, I'm going to waste money. That's where I'm wasting it.
Yeah.
So, these are kind of some silly ones, but excess weight from your car, avoid storing cargo in your vehicle. I mean, those are, up in New England, people keep their skis in their car and stuff like that, or, keep them on the roof or whatever.
Well, it used to be in the winter, you want a couple 100 pounds of sand in your trunk, right?
Yeah, I keep that in the truck. So keep your engine properly tuned. Well, that costs money, and I'm sure that's just more oil usage anyways, but whatever. Make sure your tires are properly inflated. That's actually a really big one. And it says it's 2 cents per gallon, but I've actually heard that makes a big difference on fuel economy. So there you go. Use a recommended grade of oil, and then it says basically buy an EV car. And everyone go get a Tesla.
Which is another stock that's been suffering, so apparently nobody is right now.
At least the stock.
Yeah, I mean, some of the things are pretty... you can check these off pretty quickly, like make sure your tires are properly inflated, the recommended oil. Great. I actually didn't really think about that as being something for me to take a look at, but, not using my SUV as my third garage was my takeaway. I was like, yeah, I probably can unload a lot of stuff out of that and put it, into another space. That's all.
That's funny. It's nice to know you got a third garage, Seth.
When you need it, it is, because, pandemic, you can never run too short on garage space. So, especially when you've converted one of them into a gym. Folks, that's going to do it for us in Money in the News. We are talking about no pension, no problem, and we're going to be diving into dividends, how you can create income through dividends in your retirement, or if you're not retired now, if you prefer. That's, I don't see why you have to wait, but we're going to be coming back here in a couple of minutes with no pension, no problem. You're listening to Money on Tap. Don't go anywhere. We'll be right back. Do you have an annuity? Do you understand exactly how it works and when to use it? The likelihood is that you don't, or maybe you bought it a while ago because at the time it sounded like a good idea. But will it accomplish your goals? We are here to help you. Contact us about a free annuity review and learn what your annuity does and how it can best help you in your retirement goals. It's absolutely free to you. And if there's a better way for you to accomplish your goals, this is a great way for you to learn about those opportunities too. Take the time to get educated, get empowered, make your retirement a success. Call us at 855-226-8551 or info@yourmoneyontap.com.
Now back to Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Folks, we are talking today about dividend, how to create income through dividend is part of our No Pension, No Problem show. And, for starters, if you're new to investing, or if you're new to the concept that, retirement is all about income, and this is something that's pretty critical, important if you're planning for retirement, you're in the right place. Okay, we have several other shows that we've done in sequence with this show, so please go back to the podcast, have a listen, and kind of check out some of the stuff that's critical for you in that place. And you can find us at brayshawfinancial.com or Money on Tap. Yourmoneyontap.com is our website to go resource any of those shows. Just if you didn't know that before, I think we said it a few times while we've been here. But for starters, dividends, right? Dividend stocks. And one of the things that's interesting about a dividend stock, if you were to take a look at the S&P 500, and that's kind of your bellwether out there for, investing, is that a dividend stock historically has outperformed the S&P with less volatility. And those are concepts that are fairly important for retirees, because in retirement, you want to have less volatility, you want to have less risk, and you're looking for stocks that can provide still a return or an income for you, but also kind of can smooth out that road a little bit. And there's something to say about that. Please don't think because it's a dividend stock that there is just intrinsically less risk there, because you know what? There's plenty of stocks out there that turn off their dividend, because the way the dividends work, it's one of those things that comes through profitability of a company, and if that is not happening, guess what? That goes away. So that idea is pretty important to understand, and there's ways to be investing in dividends that you really want to be paying attention and understand first. But that is one of the things that is of note when we start to take a look at this idea of dividends. And question: how does a dividend work? Even so, this is it. Let's say that you buy 100 shares of a company, and it's at $10 each. Okay, and this is the stock's paying 30 cents annually. So if you invest $1,000 over the course of the year, you would receive $30, and that's in a dividend. Where else have you seen, and that works out to a 3% yield, and that's pretty good as far as what we see on our table of stocks to invest in if you're looking for yield. But you might say, I don't know, several years ago, if you were to take a look at 3%, and you might say, well, my bank account was paying 3% or higher, or the CD was paying 3% or higher, and that was maybe a guaranteed. So maybe it wouldn't be as attractive to you at that point, with interest rates being what they are, and bank accounts paying what they used to, or CDs or any of these other places you could invest. That might be something that's more attractive and worth considering. And in terms of the total investment, the three-dimensional perspective, we want to make sure that we're doing all of these things through that lens of who you are and a part of the pie. And we're going to be getting into more of that. Ben, would you like to take it from there?
Yeah, I think a lot of people don't necessarily understand, just because it has a dividend or even has a high dividend, that's definitely a stock to buy, right? I think what a lot of people don't realize is that you're paid on the number of shares you have. So your dividend yield is something where if it doesn't matter what you paid for the stock. So if, Dan, you buy a stock for $100 a share and it's paying you $10 a year, then you got a 10% dividend. If all of a sudden that stock drops to $50 a share and I buy it, well, goodness gracious, guess what? I'm still getting the same $10 a share, but I paid half as much as Dan, so that makes my yield 20%. That's vulnerability. That's stock vulnerability that a lot of people don't understand the risk to that. So if you start shopping dividends, buyer beware. That is definitely not the thing to be doing. Like, you don't just go out and say, well, this has a better dividend, so therefore I should buy it. Now, there are times when stocks are just out of favor. There's cyclical stocks, which we mean like, if you're buying a company that just sells, toys during Christmas, well, they're going to do better in those years. So you might want to look for that stock when maybe it's Easter, so, so there's cyclical stocks that have that, or there's just companies where you say, hey, listen, it's a food manufacturer, or it's this, or it's that. And people are chasing returns elsewhere. And more people have gotten out of that thinking that that's kind of not their interest right now, or that's not where they're going to get big growth plays. But that stock starts to subside in its value. And guess what? As that stock slowly declines, its dividend yield gets more and more attractive. And that's when you're going to start seeing those stocks start gaining interest by big institutions is usually what happens. And that's when you start actually benefiting from things like that. So looking for those types of scenarios are really, really important. I think what we're going to do as we kind of dig through this segment, I think Dan and I and Seth, we're going to talk a little bit about some things to look for in the dividend space. Some of the things that we look for, because we run a fairly good sized dividend portfolio where we use, cyclical returns and things like that to try to manage and make returns and income, as well as some growth opportunity inside that. And we're going to kind of go through those one at a time. One of the first things is that dividend yield. If you're focused on it, and I think, honestly, a big piece of the next 20 years is going to be dividend returns. There's going to be a lot of people who are focused on this as a retirement asset, right? We've talked about this on the show before. We've got 320 million Americans in this country, about 40 some odd million retired, right? So we're nearing 15% of America's retired. Highest percentage in history that we've ever had retired. The baby boomers started retiring in the mid to late 2000s, and in the next 20 years, 80 million more Americans will retire. That's over 120 million Americans will be retired. That's 38% of our current population. That's an astronomical number of people retired. Now, for the same reason that we look at that analysis for where money's going to be spent and companies that are going to do well during that time, we also need to evaluate where people are going to invest to make their income, because we want to get there first. Because the more and more people buy something, guess what? Just like those real estate prices, they start surging. And so if you get into a dividend stock, it's paying you a nice yield and so forth, and somebody else is just around the corner, and they're going to retire. They're buying it after you at potentially a higher price, making your stock value go up. So you start experiencing some growth opportunity. I think that this equity space is going to, see a lot of traction and a lot of interest over the next 20 years. And we have been benefiting from that here at this firm. And we've been using that, yield story or that yield demand that's rising because of the baby boomers and those who are retired. But it's good to have an understanding of what a good yield is. Some people see a yield of 0.5% and say, or 1.5%, and they say, goodness gracious, that's really not that high. And you say, well, I really need more income to survive after. I think there's a piece of understanding that there are dividends that have some growth exposure, and then there are dividends that are just really kind of the blue chip, stagnant, not expecting to see growth unless it's, been, slowly declined in value just out of lack of interest. So that's something to look at. And I think of the stocks that come to mind, and not for any particular reason, but I think of Apple. Apple used to have like a 1.5% dividend, and it's down to, I think it's about 0.5% or something like that. Or
even less, yeah.
Yeah. And so, but it's been a growth play forever, but it has some income. But you might offset that with an ExxonMobil or a Chevron paying, north of 4.5%. And so, you look at those companies and you say, I don't think either of those companies are going out of business. And I'm happy just to hold those and average out a dividend yield of somewhere between that 3 to 4%. And that might be a piece of the story.
Yeah, I think like anything else, we hit on it already once in this show, but diversity, right? So, you can pick from a variety of stocks paying a variety of yields, but you want to make sure that it's not just the yield you're looking at. You want to make sure that you're spreading yourself out between industries and sectors, and it's still in the end a well-rounded portfolio. Because otherwise, just chasing the yield, you can suffer from performance, right? You can produce income, but you're watching your account balance drop because, typically speaking, there's not a lot of growth stocks in the yield space, right? Companies that are in the growth phase that may not really be speculative, just still growing. They don't pay a dividend because all that extra cash they produce goes back into research and development and acquisition, and they're spending the money to grow the company as opposed to spending the money to produce income for the shareholder. So, the board of directors there just has an outlook of, we're going to impress our shareholders by driving up stock price versus producing an income for them.
Yeah, that's a really good point. And I think the thing is that, understanding the goals of a company and what they're doing in their dividend and what that story is really, really important before you even step into owning anything, right? I mean, it's like if you're looking for a vehicle that's, a car that's safe, you're not going to run out and buy a motorcycle, right? You need to know what do you really want? If you want the safest car out there, I don't even know what the safest car is today, but I remember when I was a kid, Volvo had this huge safety rating, so it's like everyone wanted safe cars, wouldn't bought a Volvo, But if you didn't want a safe car, you bought a Nova or something. I don't know, So, but you got to know what you're buying and what its purpose is and what the company's agenda is. And if you don't know that agenda, that's really, really important. I think. Go ahead.
I would say there's an index out there that we look to for some of this. It's called the S&P Dividend Aristocrats, which is a pretty good bellwether of who are currently, paying the best dividends and on a track record of established a track record of likelihood to pay in the future. Because to meet the criteria here right now, presently, it's 65 companies that have increased the dividend every year for the past 25 years, have a float-adjusted market cap of at least $3 billion, and an average daily trading volume of 5 million. The index also requires a minimum of 40 companies to be included, and no sector can amount to more than 30% of the index's weight. So that's a good, quick way to say, okay, in the whole field of the hundreds of stocks that pay a dividend, which ones have been steadily increasing, which ones have been paying the longest, and which ones, won't leave me overweighted in a specific index or industry rather, a sector that, if that suffers for some unforeseen set of circumstances, it's not going to affect your dividend income nor kill your portfolio value.
Yeah, so some of the things or terms inside of those metrics are the earnings per share. And maybe you've seen or heard of this before, but this is a metric that normalizes a company's earnings to the per share value. And generally speaking, the best dividend stocks are the companies that have shown, an ability to increase those earnings per share over time. And in order to be in that dividend aristocrats, S&P 500 dividend aristocrats, that's one of the things that they are going to be showing. And historically, there's other things that have been driven off of those in terms of advisors creating ideas and where to go and put money, that they can generally have a more consistent value or return. And then one of the other things that I thought was interesting that Ben was really talking about there was the total return, because sometimes there maybe is a lower earnings ratio that you've got there, or payout ratio of dividends of, say, 1.5%. But the total return is, the increase in the stock price, known as the capital gains, plus the dividend paid. And that is a combo, like that's a 1-2 punch for, these stocks out there that really are not the most, I don't know, they're not getting the headlines, right? You're not sitting there hearing about the Teslas, or you are hearing about the Teslas. You're not hearing about some of these other companies out there that are the ones that everybody's using and all the time, or they're just such critical components to our daily lives.
Yeah, these are just the boring companies. These are the boring stocks. No one talks about them. You watch CNBC or Fox Business or Bloomberg or anything. No, they barely talk about them. It's the funniest thing. And as soon as the market starts going down, they're like, "Oh yeah, I was buying, blah 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 blah."
Flight to value. The flight to value.
Yeah.
You keep hearing about that.
Yeah, and then when you hear the flight to value, it's like they've already planned it. I mean, every one of these guys on the TV, it's funny. They all were ahead of the curve, supposedly. They probably bought one share. They didn't know it was coming any more than anybody else. They don't have crystal balls. They don't have any of that stuff.
They probably bought it in some kind of another form, frankly, where they just realized, oh, I hold that too, because it's in a mutual fund or an ETF or something like that.
Well, and I think the thing is what I'm kind of rattling through my head as I'm thinking about it is because the average listener, the average retiree is not putting money into the market, right? They've already got their money in the market, and they might be selling something that might be overvalued and raising some cash. The truth is that when we think about retirement and the concept of no pension, no problem, how am I solving retirement with this? What do you do when there's no growth, right? That total return you're talking about, Seth, you think about when there's no growth in the market, your only return, your total return is just that yield. And I think that's when, when it looks the darkest and the yield itself is strong, and the aristocrats, I mean, they're awesome. I mean, we've those 65 stocks are legendary, and they've been around, dividend increasing for 25 years, and that's great. You have something that you feel like you can count on. It's not guaranteed, but it's something of substance. When the whole market's tanking, your value is all in those yields. And I think that's the piece that you can feel secure in. If that income is enough and you're not selling shares to actually create the income you need to live off of, then you don't have to worry about the market. It's not something you're losing sleep over every second. Yeah, but someone might not increase their dividend one time. Well, they'll be out of the aristocrats, but they're probably not going to cut it completely out, most likely. Did you want to say something?
Well, I mean, it's one thing that's important to note about dividends in contrast to some of the other things we've talked about, like interest earned essentially off of a CD or an annuity or some of these other formats, is that, if you get a $10 stock that pays $1 dividend, the day it pays that $1 dividend to you, you now have a $9 stock and $1 in cash.
Yeah.
Right. So the hope is, and the intent is that the companies produce the dividend, but then increase their stock value, right? Because if the value of the company continues to decrease, even though it's paying a dividend, ultimately you have a stock working its way towards zero while you're still getting your income. So there's lots of things to consider there in choosing those, and that's why something like the Aristocrats is a great index to look to, just to give you some reassurance around the quality of the company. Again, not just chasing that yield number.
I find it crazy. I don't know about you guys, but I watch people chasing dividends left and right. People buying right before the dividend pays, selling right after. And I mean, I'll tell you, I've looked at that. I've analyzed it 3 ways to Sunday. And I know people that have this stuff down for certain companies, and they know how they're going to make a quick buck. But invariably, I've seen it where it's never worked in the favor. Like I've said, well, you know what? I collected I'm going to sell before the dividend and the rise and buy after the dip, and I'll make a little extra percentage point. It's like, it doesn't always work. And so that's why I think it's good you pointed that out, because I think people need to understand that when you collect a dividend, theoretically the stock is worth less minus the dividend. So that's healthy, but it's interesting that people trade around these things too and try to amplify their yield.
Yeah, I think that's kind of a fool's chase.
I agree.
Your average person can't sit there and do that with any kind of accuracy or predictability of a successful outcome, by any means. Because on the day the dividend's declared, it was $10 when you went in, it's $10 when you come out. It's just $1 in cash.
Yeah.
Right. So how do you make money when you begin and end at the same place?
And I think the thing is that a lot of people, and we've chatted briefly about this, and I'm going to completely change sectors, but talking about yield and talking about dividends is the real estate marketplace. We've talked about real estate and something you own, and we're big. I'm a big fan of real estate. Seth's wife's in real estate. We're all big real estate believers. But there's a lot of people out there who listen to this who know that they're not a real estate person. Like, they know that they're not going to buy the duplex. They're not going to buy the commercial office building. They don't want to be a landlord. That they don't want to be tied to a piece of property. But they believe real estate is an asset class in and of its own that they want to be part of. Now, I think it's interesting that a lot of people don't realize that as financial planners, we sit down and we will ask you what kind of real estate you own, and we'll attribute that to your portfolio as a percentage, because we don't want to overweight you in real estate. If you own, you own these 5 commercial office buildings, and this and you own that, we're not going to allocate you to something called a REIT, a real estate investment trust. That would be an equity that would trade on the stock exchange that would also have a yield. You've already got a real estate holding. We're going to try to diversify you properly and not overweight you in real estate. But real estate is a very interesting scenario, and it's had a very interesting dynamic because of COVID, which, like all stocks, just dove. But it dove for a different reason. I mean, people were fearful that, coming back to work would never happen again. It was fearful that, all sorts of issues would happen and that, everyone would be working from home forever. But then the divergence of that actually changed, mostly in the financial sectors, because almost all of the companies have asked their workforce to come back. I know JP Morgan's been, I think it was JP Morgan got pretty vocal about you come back or you don't have a job. I think that's what they did. But what I thought was really interesting, I was talking to one real estate developer. They said, because of COVID, people don't need less space because of work at home. They need more space because they're spacing out everyone's workspace more. So there's a higher demand for commercial workspace, which I never foreshadowed that being an outcome, but definitely something that's unique. But real estate is a wonderful opportunity to create yield from, and in the right scenario, in the right allocation, you can really amplify yield over what maybe some of these aristocrat stocks will do. And we have used that pretty amply in our portfolios.
You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And we are talking about no pension, no problem. Dividends, right? Those awesome things that pay you out of your investment for, sometimes it's monthly or quarterly or whatever they pay out, but you can buy something and it pays you to own it. And that's what we look at as a dividend. And at least in the stock, or typically the equity world, there's what else have we talked about? We've talked about bonds and yield and dividend and yield and all these different ways of creating income. We don't have a whole lot more time, so we're going to actually jump into some of the things that are the pros and the cons here around this dividend space and investing.
Yeah, we've talked a lot about the positive sides. I mean, we've hey, listen, this is great. Everyone's going to run and go buy all their dividend stocks today. I don't think we've done justice to the dividend market space because it is such a complex method to investing in someone's portfolio and something that we spend a lot of time on. But there's a lot of controversy around this, and not everybody agrees with the idea of equities playing a role in this space solely on dividends. Right. So I think what we're going to try to do is we're going to talk a little bit about the concept of buying like a high yield ETF versus just buying the S&P 500. And, say if you want to buy the stock market, the S&P 500, the 505 stocks in the S&P, how is that weighted compared to if I just want to buy high yield assets. Now, in doing the comparative analysis and kind of going through this, now there's just an unbalanced scenario. So I think what was probably the most interesting to me, Dan and Seth, was, in the S&P 500, almost 25% of the S&P 500 is in kind of the tech space, the technology allocation piece. But if you went into Vanguard's high yield asset class, the ETF there, they would only have an allocation of just under 10%. So going from 25% to 10% in your technology allocation, doesn't exactly ring diversification to me.
No, breaking that down a little bit further, what you find is that those types of funds are going to be very heavily weighted towards energy, utilities, and banks because they're companies that have traditionally paid a higher yield. But, that goes back to the chase of the yield, right? Do you really have a portfolio that's built and constructed to stand the test of time or produce a great dividend? Because remember, the goal in retirement is to produce the great dividend, but to do it for a long period of time.
Would you say that again, Dan? I just think it's really important for people to kind of wrap their head around that.
Yeah, you got to get the companies that are going to pay a dividend, but are going to be able to sustain your portfolio for the entirety of your retirement. So being so heavily weighted into companies, specifically banks, utilities, and energy stocks they're all considered cyclical, right? They have their ups and their downs, and they know that they attract investors through their yield story. So that's part of, I don't think marketing is the right term for it, but they know that that's a driver towards many people who make a purchase in their stock. So again, whether that's as well-rounded as the S&P 500 is, as Ben just spoke to, clearly it isn't. And history tells us, in fact, that it will underperform over time. So that yield element is a critical part of the story, but it's probably not something that warrants putting 100% of your investable assets into.
Yeah,
That's exactly where I was going with this. Is kind of getting the whole pie together, right? Because how many times have we sat down and said, look, you got enough right now that you could put the cash in the bank and live off of that cash in the bank, and you never have to worry about running out of money. Right, that's a nice situation. That's your safest scenario, but there's other factors in there like inflation and everything else that we're talking about as well. But there's probably more to this that you really truly need to grab hold of, which is that overall big picture. You want to probably have some growth. You probably want to be handing things off to heirs or causes that you really are passionate around, and so having a total solve here in trying to use whatever fund XYZ for your dividend story probably isn't the reality. It's probably not the most tax efficient way to approach this. There's buying the individual equities and being able to do some tax loss harvesting, or really a dividend manager that's maybe in preferreds that has a higher payout ratio, or the REIT stories that maybe don't have that tax advantage, but have a little bit stronger income, and they're maybe in a sector that really makes a lot of sense. So those satellites out there are part of what needs to be, a consideration in really completing the big picture here, but also utilizing the market and in all that the market is going to be bringing to bear.
Yeah, taxes are definitely a big part of this, but I think the thing is we all do. We watch financial news 24/7. I wake up in the morning. If I go to the workout, I'm in the gym, boom, financial news. Right. That's what I go to. So it's just interesting because over and over and over again, you hear all of these commentators saying things like, this is going to be the year for value. This is going to be the year for value. This is where those dividend stocks are going to come into play. The blue chips are going to rally, and it hasn't happened. And it hasn't happened through 2016. So the biggest argument, the biggest debate that goes on between growth and value and yield versus just focusing just on growth or trying to find that in between is that since 2016, the straight up market has outperformed high yield by far at a magnitude that almost seems financially unaffordable. If the market wasn't just on a rise alone and the dividend yield itself wasn't enough, you'd be in trouble, right? That's really what the the biggest argument against owning high yield, high value. But can you afford the risk, right? Everyone can afford the gain, but can you afford the risk? Can you afford this last week? Can you afford 2 days where the stock market drops 1,100 or 800 points and then fully rebounds? Like, can you absorb that craziness? Like, that's not a healthy retirement story for people on a daily basis. Like, hey, I lost 5% of my portfolio. Oh, no, I'm back up. I mean, that's crazy.
It's
like,
not healthy to watch.
Yeah,
it's killing me.
I mean, we're in the accumulation phase, so we're watching this thing laughing, and I'm saying to myself, I said to Dan, I was like, I bought more today. Like, I don't know what else to do. But the conversation around this is that you need to make sure that the dividend piece is exactly that. It's just a piece. And the tax conversation that you mentioned, Seth, I think is really important because each person has to do some planning around taxes. I mean, whether you have income taxes, if you're married filing jointly and you make under $80,000 a year, your capital gains tax is 0. I mean, your long-term cap gain, it's 0%. I mean, the only thing you could potentially be paying taxes on are dividends, right, at that point. So that could be where you could really be vulnerable tax-wise. So, selling a gain could potentially be better. So there's some arguments either way, and I think that's where the planning piece comes in because there's not just one answer, right? There's all moving parts for everybody and what income, we have here.
Folks, you're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Yeah, we're going to take a quick break, and we'll be back with kind of the wrap of No Pension, No Problem. We'll be right back.
If you're listening today and, your questions are outside the box of estate planning or financial planning or any number of the pieces that we kind of traditionally talk about, don't forget that Brayshaw Financial offers auto, home, and business insurance. And we have an entire department that handles all of that for you. Give us a call at 855-226-8551 and be happy to take care of those needs for you. Or email us at info@yourmoneyontap.com.
Now back to Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We have been spending the last several weeks, talking about No Pension, No Problem. And this is going to be the wrap for us on this whole series. Today's show mostly been focused on dividend income. Previous shows we've talked about annuities, bonds, and real estate, and you name it. Where does income come from? Or the pension, right? Because that's the original idea there in retirement, was having this solid payout that you could rely on to be able to live in retirement. It's a very different landscape today, and there's all sorts of pieces here that we want to make sure that we give all of the attention due to. And there's only a couple of minutes left for us to try to pull that in. Ben, would you please take it from there?
Yeah, I think the one thing that you kind of in the discovery phase, and all the different authors that we researched and went through, the articles from the Wall Street Journal, Barron's, you name it, Kiplinger's, Motley Fool, you name the periodical, the financial inventory that we went through. And
Reddit.
Reddit, the retirement pie. Yeah,
Not really, folks. Sorry.
I was just playing with the pun. But, we read them all. But the thing is that the retirement pie is a complex scenario that we have been mitigating. There's lots of pieces to this pie, and how you actually, make your own, pizza on this story it has variables. But I would tell you that I think what's really interesting, and everyone knows that we cover the gamut of investments. It doesn't matter whether you're doing stocks, bonds, mutual funds, ETFs, annuities, you just want to invest cash or manage cash. We do all of those core items and so many more. But what I have noticed is that, every one of these things has had a slant. Almost every one of them has had a slant towards using annuities to offset the income space that they can't generate, either because of diversification issues on the equity side or yield issues on the bond side. It is funny how almost every investment firm out there that we read was something about using annuities at a higher level than just, the 30%-ish space that kind of the pie normally holds. I thought that was interesting because they were using it for a cash asset space for people who had money that was normally sitting in a CD making 1%. They were using fixed annuities making 3%. For people who wanted diversification in the stock market, more so with some SPY exposure, but creating income, they were using that to offset exposure there. That's stuff we didn't even get into.
I think one of the things that they all point to that we know as a core element of planning that we use is that there's really only 2 things out there that promise you that income for life.
Yeah.
And it's the pension that we can't all have, and it's the annuity that anybody can buy.
Right. And I think when you're breaking this all down, we use all of these in our formulas for building people income in retirement. We use every one of them because we don't segment everything to an annuity, and you got to be careful when you meet that guy. That's super dangerous. But I do think that the argument against annuities, which was something that's long and behold an issue that was in debate for years, is no longer in debate because with yields so low and the market so high, there's very little people can do walking out into retirement and create a lifetime income that they're not fearful of without using some sort of annuity as a bridging gap. And I think that's where it comes into a foundational piece.
Yeah, I think in the last show that we talked about, that David Lau went through all those exercises to try and compute the best probability of success. And a core piece of all the best outcomes included the annuity.
I actually thought that was shockingly interesting because I didn't think that was really going to be the case. I mean, I know we use annuities regularly, but the statistical, mathematical probability increasing dramatically because of yields so low in the bond space, that was the solution that he was able to discover. And I think that's important. I don't think the story is about annuities. I think the story is really about creating income. I think annuities are able to solve that income piece for people in retirement. That's the foundational core that we talk about, like, utilities and gas and paying your mortgage. But after that, you're already overexposed in annuities if you've already covered beyond that.
Yeah, it's an even larger conversation than we've been able to have over the last several shows. First of all, what's your story? Who are you, and how are you going to transition, or how are you going to create income in retirement and giving yourself the ability to retire successfully, and then to be able to have the freedom, that peace of mind that you can go spend money and you're going to be okay. That's one of the first things that, I think really needs to be considered no matter what happens after that. Everything in the room needs to come to bear those pieces for you. Your retirement, your freedom, your peace of mind. And, what happens after that is really a unique story to you and your retirement and your income. So, folks, no matter what is going on in your world this week, enjoy it. When you get to that point where you're wondering how am I going to create this income in retirement, hey, remember, it's no pension, no problem. You can get a hold of us here at Money on Tap. We're at 855-226-8551 or info@yourmoneyontap.com. Make it a great week, folks.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551. All guarantees protections are subject to the claims paying ability of the issuing insurance company. Mutual funds and variable annuities are sold by prospectus. Please consider the investment objectives, risks, charges, and expenses carefully before investing. The prospectus, which contains this and other information about the mutual fund and the variable annuity contract and underlying funds, can be obtained from your financial professional. Be sure to read the prospectus carefully before deciding whether to invest. Fixed annuities are insurance products and are designed for long-term retirement income. Annuity guarantees are subject to the claims-paying ability of the insurance company. Surrender charges may apply if money is withdrawn before the end of the surrender period. All withdrawals of tax-deferred earnings are subject to current income tax, and if made prior to age 59 and a half, may also be subject to a 10% federal income tax penalty. Annuities generally contain fees and charges which include, but are not limited to, sales and surrender charges. Additionally, if purchased within a qualified plan, an annuity will provide no further tax deferral features. The contract, when redeemed, may be worth more or less than the amount used to purchase the annuity. Fixed annuities are contracts, and you should read and understand the contract before making a purchasing decision. All other benefits are available for an additional cost. It is important to weigh the costs against the benefits when adding such options to an annuity contract. An income rider or benefit, sometimes called Guaranteed Lifetime Withdrawal Benefits, or GLWB, is an additional feature available with some annuities and generally optional and comes with additional cost. Income benefits are designed to provide income options above and beyond the standard annuitization or free withdrawal features in annuities.
Well, bye.